Hello, welcome European listeners and market participants, and welcome to KBRA's European Credit Podcast, Conversations in European Credit. I'm Gordon Kerr, Head of European Research at KBRA, and today I'm joined by my colleagues, Ken Egan from our Sovereign Ratings team and Karim Nassif from our European Project Finance team. Today we will be covering the topic of energy in a European context. Global energy markets appear to have entered a period of relative stability in Q1 2023, compared to the exceptional volatile energy prices experienced during the first 9 months of 2022. This stability may be short-lived in Europe, given ongoing supply-side influences, such as geopolitical risks and infrastructure challenges. In addition, elevated interest rates and recent bank concerns could impact markets. Corporates, project finance, and sovereigns will be impacted in differing ways if prices remain stable at current levels. Europe has reacted strongly and collectively to the supply shock after Russia invaded Ukraine in February 2022, but challenges remain. Have we entered a turning point regarding energy price exposure and extreme energy price volatility? Does this now change the macroeconomic prospects for inflation, interest rates, and credit conditions for European sovereigns, corporates, infrastructure, and project finance issuers for the remainder of 2023? So let's dive into the topic. Now, first, let's discuss the energy market and how it is shaping up with regards to the dynamics. Welcome, Karim. How are you?
I'm well, thank you, Gordon.
So where do you see the energy markets currently, and how are they developing?
So in terms of the demand, Gordon, a couple of important things need to be taken into account. First of all, we've seen much less demand from Europe, and this sort of comes off the back of an intention to voluntarily reduce natural gas consumption by 15% between August and 2023 March, set at EU level. Now, they are meeting that target. According to Eurostat, 18 countries actually already shot that target between August and November. Bruegel, the think tank, thinks that, or estimates that EU natural gas demand was 12% lower in 2022 than the average between 2019 and 2021. So this reduction in demand, it comes from a combination of policy measures, mild climate conditions, high prices, and the effects of the macroeconomic downturn. In terms of the other important dynamic is China's growth. Now, that has underperformed following strict COVID measures maintained over the winter and a global slowdown led by high inflation, energy prices, and increased interest rates. This led to much lower than expected molecule-on-molecule competition between China and the EU for natural gas. And that has actually made it easier for Europe in terms of the general conditions. China is not the only important buyer of LNG in Asia, of course. There are others, including, for example, Japan, South Korea, and others. So as the Chinese market and the general Asian economy recovers to a degree, that's going to put potentially more pressure on the EU market as well in terms of being able to secure supply, but also in terms of the price at which LNG purchases occur. The uncertainty regarding future LNG prices, which depends to a large extent on the global macroeconomic recovery, next winter's anticipated weather, and the degree of demand from Asia will all be things to watch.
What about the renewables picture? We partially covered this topic on a previous podcast with regards to solar energy and the growth that we are expecting to have here in Europe. We've also discussed the European regulatory environment and where it's headed in a recent ESG Talks episode with Emily Nadler. But where do renewables fit into this discussion?
So renewables are really important to monitor as well in terms of the overall sort of ability of Europe to wean itself away from dependency on Russian gas and indeed dependency on fossil fuels in the broad sense. And the news is positive on that front. Solar and wind, for example, generated 1/5 of Europe's electricity in 2022, overtaking gas for the first time, according to the World Economic Forum's January 2023 report. The consultancy Ember, the think tank, suggests solar capacity increased 24% in 2022, which was double its previous growth record. And by contrast, for example, coal generated just 16% of the EU's electricity last year, an increase of just 1.5% versus 2021. And that leaves coal's contribution to the energy mix still at historically low levels. The current EU plans, are to further increase renewable capacity from wind and solar, thereby increasing their proportion of energy production as part of the national energy and climate plans for 2030.
So if we turn now to what Europe is doing on the infrastructure side, what is being done to improve that supply side and reduce the reliance on Russia?
So I think we have to look at a number of important measures that have occurred on the supply side. And I would sort of compartmentalize these into probably three essential measures that have helped Europe. One of them is replacing the Russian gas with LNG imports, primarily from the US, but also from some of the Gulf countries. So Europe was the largest customer in terms of global LNG in 2022, importing substantially higher volumes than rival buyers, as it really aimed to place and reduce Russian supplies. The other thing to consider is the rise in Europe's investment in regasification infrastructure. So this LNG that they are now finding new markets to source it from needs to be regasified when it comes into Europe's import terminals. And to this end, the EU aims to increase the number of floating storage and regasification units, FSRUs, which are actually cheaper to install than onshore facilities, materially. At least 25 new FRSUs are planned across the EU over the next few years. Germany is currently building 5 new FRSUs, as well as 2 permanent onshore LNG facilities. And the Netherlands has commissioned its first LNG import terminal in Q4 2022 and has recently added 2 FRSUs. Italy is also increasing its supply from North Africa and is expanding its LNG capacity. The EU is making important steps in weaning itself off of that Russian gas in pursuing these measures. Lastly, I would just mention that from a storage perspective, the situation is also looking significantly healthier than at the time when Europe was reacting to the onset of the Russian Ukraine conflict. So as we look, for example, at storage regulation in June 2022, it requires that storage sites be filled by at least 80% of capacity before the winter of 2022-2023. Now, what we are seeing is, Europe meeting some of these objectives. European gas storage levels currently are projected to be between 45 and 61% at the end of this winter. This is about 15% above average of the recent years, and storage levels could reach 88 to 100% by September 2023, which is at the high end of historical outcomes, according to various sources, including Cornwall Insight. Now, this should help ease pressures on supply and pricing if sustained.
Many thanks, Karim. Now let's turn our attention to the government and regulation and that side of the market. And welcome, Ken. How is the EU adjusting to the framework of energy in Europe?
Yeah, thanks, Gord. EU energy ministers agreed to a dynamic cap on natural gas prices in December of 2022, with measures applied from the 15th of February this year. The mechanism is automatically activated under 2 conditions. One, if the month-ahead contracts exceed €180 per megawatt hour on the Dutch TTF for 3 consecutive working days. And secondly, if the price is €35 higher than a reference price for LNG on global markets for the same period. At the same time, the EU agreed to set an oil price cap for crude oil, petroleum oil, and oils obtained from bituminous minerals that originate from or are exported from Russia at $60 per barrel. The price cap on Russian crude oil, effected on the 5th of December last year, was designed to reduce Russia's oil revenues while allowing crude oil to keep flowing and prevent a spike in prices. Both measures on oil and natural gas followed earlier price measures applied in September of last year. Although it's too early to tell, oil and gas price caps have the potential to contain the impact of large increases in wholesale energy costs to utility suppliers in Europe, and should lead to less volatility. In contrast, they could lead to a contraction in exploration and development, as well as divert supply previously destined for Europe to other markets where such caps do not apply, thus exacerbating Europe's energy security of supply issues. The European Commission has already proposed legislative reforms on the electricity market this month, and this now needs to be agreed by the European Parliament. This should make the market more resilient in the long term, contain excessive price volatility, and ensure secure energy supplies, especially from clean resources.
Okay, now let's focus on the impact of all this. Ken, where do you see this having an impact on the sovereign side?
The outlook for EU economies incorporates relatively higher energy prices, geopolitical uncertainty, and tighter credit conditions. And these will likely continue to place downward pressure on growth. As a result of elevated inflation levels, the potential for them to remain elevated or sticky, European central bank rates could exceed expectations and stay higher for longer. Core European inflation could move higher than headline inflation and potentially stay above target over a 2-year horizon. Sustained inflation at current levels, coupled with rising cost of living, erodes savings and dampens consumption. Geopolitical uncertainty and tighter monetary policy conditions could temper investment and business activity. However, economic activity has recently been underpinned by government policy actions taken to shield households and businesses from extreme energy pricing. EU growth numbers in recent quarters have outperformed many market estimates, partly due to the extent of government policy actions. Fiscal aid for consumers to manage energy bills and supports for energy-intensive industries have seen the region avoid a recession to date. In a potential downside scenario, sticky inflation at elevated levels could continue to place upward pressure on input costs for firms and squeeze profit margins, weakening investment, expansion, and ultimately reducing the need for labour. Just as an aside, we would highlight that the reaction of European sovereigns to the energy crisis and their efforts to diversify away from Russian fossil fuels underpins the cohesion and security within the bloc. Overall, the recent reduction and stabilisation of energy prices has alleviated pressure on inflation rates in Europe. For example, the euro area harmonised index of consumer prices was 8.5% in February 2023, down from 10.6% last October. Historical data shows an increasing correlation between inflation expectations in the euro area and oil prices. This has slightly diverged in more recent periods and could help anchor inflation somewhat. If the trend of stabilisation and lower energy prices is sustained in 2023, this may potentially help contain inflation expectations and steady the path for interest rates.
So if inflation is going to be sticky, what does this mean for rates?
Yeah, I guess ultimately energy costs find their way into fixed input costs and eventually wages and services. As such, central bank policy rates and market rates could remain higher for longer, especially considering the ongoing supply gap in European energy. Recent issues surrounding financial stability within the banking sector may usher a slight pause and pullback in the pace of rate rises, which the Euribor curve reflects over the last 2 weeks. However, it is clear that rates are expected to persist at an elevated level relative to the past decade, and this could challenge some key foundations of Europe's growth. Financing, energy, and labour are all becoming more expensive inputs, and this might become a more permanent theme of European growth. Some wage indicators suggest that the cost of labour has risen substantially compared to the pre-pandemic average, while energy costs are still significantly higher than the average price level in the pre-pandemic years. And the cost of credit is several hundred basis points more since the ECB raised its policy rate. The Euribor futures curve would imply that policy rates could still be around 3% over the medium-term horizon. Despite progress in energy diversification, European markets could remain somewhat vulnerable as long as the big supplier in the market, Russia, is absent and goes unreplaced. This energy supply gap could underpin energy prices and thus inflation and policy rates.
Thanks, Ken. If turning back to Karim, have we reached a turning point for credit conditions for corporates and projects because of this stabilizing or potentially stabilizing inflation?
Well, as you've heard from Ken, I think there's, on the one hand, some positive effects because of, I guess, the dampening headline inflation figure that we're seeing, some contraction in corporate spreads. the reduction in energy bills to consumers and businesses. However, we also are aware that the macroeconomic conditions remain subdued. There's a number of challenges on that front. And it's obvious that the potential for volatility to come back into the system remain high. It's important to stress also that while energy prices have fallen, they're still somewhat higher than the pre-pandemic levels, and they're expected to remain so in the short to medium term. The potential for volatility played out most recently with the run on the technology banks in the US and, of course, what happened to Credit Suisse. Clearly, the short, medium, and long-term effects of the recent accelerated rises in rate hikes on financial institutions as well as corporate and project may need time to fully play out. Further, we consider that while the combination of replacement of Russian gas supplies in the EU and the active reduced demand have been supportive for energy prices in containing inflation, a number of events, we could call them perhaps black swan, could lead to the return of the future energy price spikes that we saw before, including, for example, but not limited to, Chinese growth returning much higher than expected, more geopolitical issues, weaker execution pipeline of renewable projects, supply interruptions, or OPEC cuts.
Thanks, Karim. So which projects, corporate and infrastructure entities are really most fit to deal with the volatility and inflation and in the macroeconomic conditions going forward, and which are likely to fare worst?
Thank you, Gord. I think we go back to the 2 points we raised earlier. So subdued macroeconomic growth conditions, so that will impact the sectors in Europe that are most exposed to economic cycles and or consumption. The energy prices remaining high, notwithstanding that they've subsided relative to pre-pandemic levels, they remain high. And so, manufacturing, energy-intensive sectors continue to be at risk, as well as any utilities that have, challenges passing on costs. KBRA distinguishes between corporates, infrastructure, and project finance entities that are exposed to energy prices or sporadic dips in economic cycles, on the one hand, and those entities that operate in more defensive sectors or benefit from contracts that allow the pass-through of higher costs. And I think the ones that fall in the latter category, it's important, in our view, to be a little bit more introspective and to look with a finer tooth comb on the potential pass-through risks that may emerge in what might otherwise be considered as stable infrastructure stroke project finance type transactions. We consider the market is adopting a fairly broad definition at times of infrastructure, for example. And when looking at the newer technology sectors, for example, tower telecoms, operators, fiber to the home, not all of these transactions operate in the same way or in the same jurisdictions under the same frameworks. You can have situations where competition can create a situation of overbuild in certain areas, for example, in fiber to the home. And in such an environment, how easy is it for, let's say, a fiber to the home business to pass on costs when there's more competition potentially around the corner? In other cases where there's an absence of a long-term contract, certain infrastructure borrowers may be more at risk than others. Regulators make decisions all the time on how to provide adequate remuneration. In some markets, that stability of regulatory decision-making is less predictable than others. And what we see, for example, are situations where regulators are due to make forecasts out 3 years, for example, in the Spanish market for electricity, which could have consequences for energy producers if prevailing prices end up being much lower than what the regulators are currently projecting, especially in the absence of sufficient and timely cash compensation. So in our view, it's going to be an interesting time, not just in terms of the corporate versus the infra defensive sectors, but also within infra and project finance to further elaborate and delve into the potential more hidden risks in the ability to pass through costs. Further, when it comes to infrastructure provision of public services, affordability factors, of course, come to the forefront, as we have witnessed with the activity of utility suppliers.
Now, what about interest rate side of things, how is the impact of higher rates going to fare on corporates and I guess more specifically projects and infrastructure?
So, as discussed, the market is probably yet to see the full impact of high interest rates on the credit quality of corporates and projects. Now, interest rate hikes can take time to filter their way into corporate and project performance, depending on the sector and the contractual mitigants. We think this is particularly the case for entities that are either facing a wall of refinancing risk in the short term and may be of lower credit quality, or perhaps lacking in sound and sufficient banking and capital market relationships, or entities that have to undergo significant expansion and maybe currently don't have levels of committed funding allocated. Within this latter group, one could also consider some of the important national utilities that have an essential role in the energy transition, and where increasingly CapEx requirements are significant in order to meet certain of the Repower EU and energy transition plans. It'll be important to see how those entities are going to fare in terms of the funding environment, in terms of adequate remuneration under regulation. In our view, the majority of highly rated European corporate infra and project issuers have tried to lock in rates when they're facing immediate sort of refinancing requirements or new financing requirements, rather than risk the uncertainty. However, those that are facing sort of longer-term refinancing risk requirements, in some cases have decided to defer until a time when they consider the market has returned to more stabilized conditions. Some issuers are now, especially on the lower-rated scale, looking at hedging, either because their lending group is requiring them to do so or because they want the extra protection. In our view, refinancing risk has not just increased because of higher interest rates, but it's also the uncertainty associated with the future operating profiles at the time when refinancing is expected to occur. So if we consider, for example, an entity with a mini perm in 5 years' time, it may not just have to deal with the higher rates prevailing and the higher inflation, but also potentially new risks associated with energy costs that are prevailing, as well as potentially risks associated with technology such as obsolescence that are emerging, and may find it particularly challenging if all those risks come together in 5 years' time to convince bank and capital markets to lend in those conditions.
Great. Thank you very much, both Ken and Karim. As energy prices have subsided from their recent highs, along with indications that inflation rates are starting to fall, sentiment has improved. The pandemic's impact appears to have been absorbed by many companies, although some were meaningfully tested. It is apparent that the better structured entities and transactions and issuers that operate in more defensive sectors were best positioned to weather macroeconomic effects. Volumes have returned to more impacted sectors, such as airports and toll roads, at levels that are close to or equal to pre-pandemic levels. So as outlined by Ken and Karim, the focus for 2023 now centers around uncertainty associated with the future interest rates, inflation, and the geopolitical outlook. Volatility in energy prices has abated, but numerous supply and demand factors can rapidly weigh on what is a finely weighted supply-side dynamic. In KBRA's view, defensive sectors and entities with contracted and regulated cash flows are best prepared to countervail the uncertainties in 2023, as outlined by Karim, and those exposed to energy markets and entities in need of refinancing are the most exposed to the risks of sustained higher rates of both inflation and borrowing. KBRA has been actively monitoring the development of this market in Europe, and you can hear in our past podcasts and can also read reports on our website. Make sure you are registered to receive our latest comments and have subscribed to our podcast, and of course, are engaged with our experienced analysts. Thank you very much for listening. We look forward to bringing you more conversations in European credit. Stay positive out there as we all navigate through what is a challenging time.